Dividends are a scam. Okay, that's a bold claim, so let me be crystal clear here. The act of a company sending you cash isn't a scam. The scam is the story you've been sold about what the payment actually means. You're told it's free money, a little reward for being a loyal shareholder. You're told it's the key to passive income, the secret to getting paid while you sleep. That story is a lie. It's a lie that feeds on a basic misunderstanding on how the stock market works. It's built on a simple accounting trick that once you see it, you can never unsee. And falling for this lie doesn't just cloud your judgment, it can steer you into huge portfolio crushing mistakes that can set your financial goals back by years. So I'm going to pull back the curtain on this so-called free money. I'll show you the simple mechanical adjustment that proves it isn't free at all. Then we'll walk through the 3 biggest mistakes investors make when they fall for the dividend lie, the dividend trap, the tax drag, and the growth illusion. By the end of this, you won't look at dividends the same way again. You'll be a smarter, more informed investor, immune to one of the most pervasive myths out there. If you're ready for the truth they don't tell you in those get rich with dividends videos, stick around. And hey, if you appreciate analysis that respect your intelligence, do me a small favor and tap the like button. It tells the algorithm that investors like you want real answers, not just fairy tales. Let's be honest about why this myth is so powerful. Without a doubt, one of the most seductive concepts in finance, especially if you're just starting out. It's easy to see the appeal. Think about it. You buy a share of a company, some giant corporations like Coca-Cola or Home Depot, then every 3 months, like a clockwork, a little bit of cash gets deposited right into your brokerage account. It feels like a reward. It feels like you're a real business owner, a partner getting you a slice of the profits. This is the passive income dream, right? The money just shows up. You didn't have to clock in, go to a meeting, or do anything other than just hold on to your shares. The feeling is tangible. While your friend with a high-flying tech stock that pays no dividend just watch a number bounce around on a screen, you're getting real spendable cash. It's a powerful psychological hook. In a world full of abstract financial jargon and wild market swings, a dividend is something concrete. You can track it, count it, and even set up your account to automatically reinvest it, creating that satisfying loop where your money starts making more money all by itself. Financial gurus have built entire empires on this feeling. They sell a vision of a dividend snowball where your small investments grows into a massive income stream that one day covers all your bills. They flash spreadsheets with cascading green numbers, promising a future where you're living off the quarterly check from your portfolio. The message is very simple. Buy these stocks, hold them forever, and enjoy a lifetime of ever increasing free money. It sounds safe, it sounds responsible, it sounds like the perfect escape from the risky world of growth investing. And this is where the scam begins. It's not some malicious plot by a man in a top hat. It's a scam of omission, a half-truth that sounds so good we don't bother asking about the other half. We're so focused on the cash appearing in our account that we fail to notice the value disappearing from somewhere else. Okay, so let's get to the core of this. This is the simple accounting trick that proves dividends aren't free money. The easiest way to understand this is with a simple analogy. Imagine a company called Box Corp. This company is literally a box. Inside the box is a business, and let's say there's also a pile of cash worth $1 million. The total value of everything in the box, the business, the asset, the cash, is $10 million. A Box Corp has 1 million shares out there. That means each share is worth exactly $10. Simple enough. 10 million in value divided by 1 million shares is a $10 share price. You own a share of Box Corp, it's worth $10. Now the board of Box Corp decides to reward shareholders. They announce a dividend of $1 per share. You're thrilled. You're about to get $1 in free money. But where does that dollar come from? It doesn't materialize out of thin air. The company has to take it from the pile of cash inside the box. So the company takes $1 million in cash, $1 for each of the 1 million shares, and hands it out to the shareholders. You get your dollar. But what just happened to the value of Box Corp? The box still has the same great business, but that $1 million pile of cash is gone. The total value inside the box is no longer 10 million, it's now $9 million. The company is literally worth less than it was a moment ago. And since there's still $1 million shares, what's each share worth now? You guessed it, it's worth $9. So let's recap your financial situation. Before the dividend, you had 1 share of stock worth $10. Your net worth was $10. After the dividend, you have 1 share of stock worth $9 and you have $1 in cash. Your total net worth is still $10. You are not $1 richer, you have simply turned $1 of your stock's value into $1 of cash. The dividend wasn't a reward, it was a transfer. The company took money out of your left pocket, your stock's value, and put it in your right pocket, your cash account. This isn't just an analogy, this is exactly what happens on the stock market. It's a standardized mechanical process governed by one key data, the ex-dividend date. The ex-dividend date is the day a stock starts trading without the value of its next dividend payment. If you buy the stock before the ex-date, you get the dividend. If you buy it on or after the ex-date, you don't. The seller keeps it. Because of this, the stock exchanges automatically adjust the stock's opening price down by the exact amount of the dividend on the morning of the ex-dividend date. So if a $50 stock is about to pay a $0.5 dividend, on the morning of the ex-date, it will open at $49.5, all else being equal. The market then trades from that new lower starting point. The free money was an illusion. It was a forced liquidation of a tiny piece of your ownership. Thinking it's a bonus is the fundamental error that leads to terrible investment decision. And once you realize dividends aren't free, you start to see the risks are everywhere. Believing the free money myth causes investors to make predictable and costly mistakes. Let's break down the three biggest ones. Mistake number one is the siren song of the dividend trap. This is probably the most dangerous mistake of all. When investors get obsessed with income, they start chasing stocks with the highest dividend yield. The yield is just the annual dividend divided by the stock price. A company paying a $2 dividend with a $100 stock price has a yield of 2%. But if that stock price falls to $50, that yield jumps to 4%. And if that price crashes to $25, that yield shoots up to 8%. A novice investor sees that 8% yield and thinks, wow, an 8% return guaranteed. They see a huge bargain. What they don't see is that sky-high yield is almost never a sign of a great company. It's a flashing red warning light that the company is in deep trouble. The yield is high because the stock price has been collapsing for a reason. This is the dividend trap. You're lured in by a big juicy dividend, but you're actually buying a ticket on a sinking ship. The market is hammering the stock because earnings are collapsing, debt is out of control, or its entire business model is going extinct. A perfect painful example is Walgreens. In late 2023, its stock had been tanking, which pushed its dividend yield up to a very tempting 9%. As a dividend aristocrat with a nearly 50-year streak of raising its dividend, it looked like a safe bet for income. But that high yield was a warning. The company was facing falling profits and a payout ratio, the percentage of its profits paid as dividends, of over 290%. It was paying out nearly 3 times more in dividends than it was actually earning. In January 2024, the inevitable happened. Walgreens slashed its dividend by almost 50%. Investors who bought for the high yield got hit twice. First, their expected income was cut in half. Second, the stock price collapsed even further on the news. The safe income stock became a total disaster. Chasing a high yield without asking why it's so high is like following a siren song straight onto the rocks. Mistake number two is the invincible thief called tax drag. So let's go back to the box corp. You started with a $10 asset. After the dividend, you have a $9 asset and a $1 in cash. Same net worth, so no harm, no fool, right? Wrong. There is a silent partner in this transaction, the tax man. When your stock goes up in value and an unrealized capital gain, you don't owe any taxes. You only pay taxes when you choose to sell the stock and lock in the gain. You are in control. But a dividend is a taxable event. The moment that dollar hits your account, it's considered income and you owe taxes on it for that year. So let's compare it to investors. Investor A owns a $100 non-dividend stock that goes to $105. Investor B owns a $100 stock that pays a $5 dividend. On the dividend date, investor B's stock drops to $95 and they get $5 in cash. Both investors have the same 105 net worth, a 5% total return, but their tax situations are completely different. Investor A owns 0 taxes, their 5% gain is unrealized, safely compounding inside their stock. Investor B, however, just got $5 of taxable income. Depending on their income, they could owe 50% or more on that $5. That's money immediately yanked out of their portfolio, unable to grow and compound for the future. This is the tax drag. It's a small invincible leak in your portfolio. Year after year, being forced to pay taxes on dividend instead of letting your gains grow tax deferred systematically chips away at your total return. The dividend didn't just give you cash, it gave you an involuntary and inefficient tax bill. The final mistake here is opportunity cost. By focusing so narrowly on dividend income, investors often ignore the single most important metric for building wealth: total return. Total return is the real scoreboard. It's the combination of the change in the stock price, capital appreciation, plus any dividend you received. Total return equal capital appreciation plus dividends. A dividend first mindset creates a dangerous illusion. It makes you feel like you're earning a good return because you can see the cash, even if your total return is pathetic. Let's look at a real world example. Two popular ETFs, the Schwab US Dividend Equity ETF and VOO, the Vanguard S&P 500 ETF. An income investor loves the Schwab Dividend ETF because its dividend yield is so much higher than the S&P 500 500 ETF. But what about the total return? Over the last 10 years, even with all dividends reinvested, the S&P 500 has crushed the Dividend ETF, and investment in the S&P 500 a decade ago would have grown far more than the same money in the Dividend Schwab ETF. This shows that capital appreciation is often a much more powerful engine for wealth than dividend. By filtering out non-dividend paying growth stocks, the dividend investor missed out on a massive source of growth. They were happily collecting their dividend checks, feeling good about their income, while their total net worth grew much slower than someone who just bought a simple market index fund. The lie of free money made them choose a small, tangible cash payment over the much larger, more powerful force of long-term growth. So if dividends are a scam, should you sell every dividend stock you own? Absolutely not. That would be just as short-sighted as chasing high yields. You have to also remember, I'm not a financial advisor. Make sure you do all your own research before doing anything. The scam isn't the dividend itself, it's the idea that it's free money and the most important factor in investing. The solution is to shift your entire mindset away from income and toward total return. A smart investor understands that a dollar is a dollar, whether it comes from a dividend or a rising stock price. In fact, a dollar from a rising stock price is often better because it grows tax deferred. You don't judge a company by its dividend yield, you judge it by its ability to grow its overall value. This means that a dividend is just one small piece of the puzzle. Instead of asking what's the yield, you should be asking better questions. So, number one, is this actually a strong business? Look at its revenue growth, profit margins, and competitive advantages. A great business is the foundation of any great investment. And secondly, is the dividend sustainable? Check the payout ratio. Is the company easily paying the dividend from its profits, or is it straining itself, risking a future cut? And number three is, does the company grow its dividend? A history of consistent dividend growth is a powerful sign of a healthy, confident business. This is way more important than a high starting yield. And number four, how does this fit my total return goal? Stop separating your stocks into income stocks and growth stocks. They're all just tools in a single portfolio designed to maximize total long-term growth. When you adopt this philosophy, everything changes. You realize that if you need cash, you don't have to wait for a company to pay you. You can create your own dividend anytime by simply selling a small portion of your shares. This gives you total control over when you take profits and is often far more tax efficient. A couple of nobles famously argued that a company's dividends policy is irrelevant to its total value. Whether a company pays out a profit as a dividend or reinvest them to grow the business, increasing the stock price, the total return to the shareholders should be the same. Their point is profound. Don't get hung up on the method of the payout. Focus on the quality and growth of the business. The idea that dividends are free money is one of the most persistent and damaging lies in personal finance. It's a comforting story that makes us feel safe while exposing us to hidden risk and inefficiencies. We've seen that dividends aren't just a bonus, they're just a transfer of value you already owned, where the stock price is reduced to give you cash. We've seen how this lie leads investors into dividend traps that destroys capital, tax strikes that bleed returns, and a narrow focus that causes them to miss out on much bigger growth opportunities. The truth is, dividends aren't good or bad, they're just a tool, one way for a company to return capital to its owners, but they are not and never will be free. The smart investor doesn't get fooled by accounting tricks or seduced by promises of easy income. They focus on what truly matters, the fundamental strength of the business they own, and the total return their portfolio generates over the long term. Stop chasing income and start building wealth. Thanks for watching. If this video changed your perspective on dividend investing, consider subscribing for more content that cuts through the noise, and I want to hear from you in the comments. Did you used to believe dividends were free money? I'd love to hear your story, and I'll see you guys in the next video.